You know, putting in a bit of a charge up here, but yield can only go so far. Otherwise, it could potentially invert the curve. There's that seller, guys, again at 65s. Hopefully, we should see a big break of that seller at 65. That's another 2 occasions that that seller's came back out and sold that same 65 print, guys. My goodness. So hopefully we get that seller to run away from this bit of business here, and we'll get a nice big squeeze through that 65 print. Anyway, let's see what happens. So the 2-year yield rising, and the key to the 2-year yield rising, of course, is whether it flattens the curve or whether it can hold on to most of its steepener. If it does, the 2-year yields can keep going higher. So when we look at the 30s minus the 2s, which is effectively the whole curve, we can see a couple of things. First of all, we can see that the curve is usually a negative correlation, and that's pretty obvious. The curve is usually a negative correlation. So if the curve, and a lot of people, they prefer to do the 2s minus the 30s so that you can look at the positive relationship to this, because obviously as 2-year yields rise, you would imagine as 2-year yields start to move, it's going to have a negative impact on longer duration yields. Now that's pretty obvious, because that's the reason for it rising, is it's to get inflation at the further out durations under control. So when we see this, we can start to recognize a couple of things. We can start to recognize that so far the curve is still relatively doing okay so far. You can see that the curve hasn't gone particularly negative. If we zoom out a little bit, you can see a couple of the times that the 2s 30s really does. Now they're not flattening to zero, are they? They're not necessarily flattening to zero, but they're really flat down here. The curve is very, very flat in those areas. And obviously in those areas, one would imagine that 2-year yields probably have limited scope for the time being, and selling into this for the time being. So what happens? Well, you would obviously be looking at selling 2-year yields. When the curve is away down here, you'd be expecting to sell 2-year yields. And you can see that selling 2-year yields has this very, very big draw down effect here. And you can see the same in this area here, selling 2-year yields. Now, obviously, when the 2-year yield collapses, we get this very, very, very extended growth on the 2s 30s curve. And obviously, it gets to a point where yields are simply looking at it going, wow, we've got room to keep going here. And obviously, if you've got room to keep going, obviously, we're talking about these kind of levels up here, then obviously what happens is you can start seeing the 2-year yields being purchased, because there's plenty of space for them to be purchased into. So the buyers of yield comes in here, the buyers of yield come in here, the buyers of yield come in these spikes, and obviously the yield rallies, but then we get this fast money drop on the curve, didn't we? Fast money drop on the curve. So we get this fast money drop on the curve. What are we expecting? Well, we're expecting at some stage for the 2s to slow right down again. You see that? The 2s to slow right down again. And what happens? Well, you can see what happens. We get a new peak at the same price, or a new trough at the same price, and 2-year yields do slow down. But what's happened since then? Well, what's happened since then is that we've seen the without the 2s dropping, and that's the interesting thing, the 2s haven't dropped. We've actually got the curve improving again. So obviously with the curve improving, the 2s have got space to keep moving. And if the 2s have got space to keep moving, bonds will keep building a bit of a concession in here. So we've obviously got space for the 2s to move. Therefore, the short-term interest rates are building a bit of room. And if the short-term interest rates build a bit of room, we need to make that room at the back end. Otherwise, well, we don't really need a concession. So we obviously can see exactly what happened. You can see the price got a big lift today, where the yields are very, very strong today. And the curve is also very, very strong. Considering where the yield has made new higher highs, you'd have imagined that higher highs is normally going to do what? Well, you can see what higher highs does to the curve. Look. When we get this break, for example, of this area here, a new higher high on 2-year yields, a big drop on the 2s 30s curve. A very, very strong higher high here on yields. You can see this very strong higher high here on yields. You can see a very, very sharp decline in the curve. But take a look at this higher high here on yields. The curve's actually going up, not down. So in other words, the 30-year is still kind of lagging behind this as a storyline, and therefore the 30 has room to keep, the concession has room to keep going, basically, which is what we're seeing right now. Let's take a look at last month's to compare what we saw last month into that very, very nice concession process, if you recall, from the beginning of the month. We started to see yields really cooking for gas, but you can see what happened when we started to see this spike here. It just stops right there, doesn't it? Stops the yield moving, stops the yield moving in those areas. And obviously you can see that that gives us the idea that these key levels on the 230s curve are actually very, very, very important. Well, we've told you that many times before. The curve key levels are massively important so that we can see this concept of inverted curves, for example. Now you may be saying, but how do we know whether this is inverted or not? Well, of course, if you're interested, you can obviously just change the, hold on a second. Right, guys, so if you want to know whether the curve's inverted, what you can just do is just put a second scale on your right-hand side of your charts, right? All you have to do is put a second scale on it. So all you do is change the scale on this one and adjust it. So you can obviously pin a new right-hand scale, and obviously if you put a new right-hand scale, you can obviously just change that to regular, and you can see what these actual levels are. So you can see it's not actually inverted. You can see it's not exactly a stellar difference between the 2s and the 30s at this stage. It's only 0.18. It's only 18 basis points difference. And obviously at the very, very top edge here, it's 60 basis points different. 60. So obviously you start getting used to how low is low and how high is high, that type of idea. And you start recognizing these areas. Now you can see where the low seems to be in just now in terms of this chart. You can see that every time we seem to drop down into these areas here, that seems to be a low just now, which is around about 38 to 40 basis points. Now 38 to 40 basis points is 2 interest rate hikes between the 2 years outlook and basically anything longer than 2 years. So you can see that difference, and you can see obviously that difference starts to show you some interesting trade levels. Now if you look at this on a bigger time frame chart, you'll see this in basically all its glory. You can see the key levels, can't you? Well, hopefully you can now see the key levels. So one of the key levels that we had in the past was obviously this key level here. We can all agree that that is a very, very strong looking key level there. And we can see that in the past, when the curve gets as high as this, we seem to also see a key level developing. And we can all agree that that is very, very, very big for a key level in there as well. So why are these key levels so important? Well, of course, when the curve hits these key levels, the curve is very, very, very flat, and it's caused the banks to buy the curve. They bought the curve for a steepener. Well, if they're buying the curve for a steepener, they do that a lot of the times by obviously dropping rates. Short-term rates, dropping short-term rates. In other words, they start selling those short-term rate products and you know, short-term rate products to try and get the curve to move. So we can start to see what's going on in here in terms of yields, right? We can start to recognize the 2-year yields, and we can see that when we, unfortunately it's going to rescale it, of course, but we can always just keep drawing out the areas. We can always draw these areas out, and we can start watching for these levels reappearing. Now, we don't know where the level is going to be until the level's there, right? But we can start to see these levels. We start seeing when the curve is at the low edge here, the probability is the 2s are limited in their scope for continuation. So we can see that when we reach into these areas here, you know, you only know a level when it forms, but there's a level there. Now, we've seen some real levels in the background, so there's a very high chance there that there's nowhere for the 2s to go at that stage. There's limited space for the 2s to move at that stage, and there's limited space for the 2s to move at that stage. So we can already recognize that these are very, very important price areas to start recognizing potentially bond opportunities. Now we do this with the 230s, but we normally do this with the 210s, of course. But the 230s has a little bit more curve attached to it, gives us a few more clues about what's happening. And obviously into the top edges, you can already recognize that there is a fairly good top edge up there. We've seen a couple of sell responses, a very good response there. And obviously again on a retest there, you can see those areas. Selling the curve means that we're getting higher yields. Now, when you see this, you might then ask the very simple question, so what? Well, obviously, if we look at the bond price against the yield, and we look at this area now in particular, and we look at bond prices against yields, one of the things we can recognize is it should be a negative correlation to a greater or lesser degree. It should nearly always be a negative correlation, shouldn't it? So obviously, if we start seeing it as a negative correlation, at least it gives us a couple of insights into what we would expect to see starting to happen. And obviously, it gives us a few clues about where we can maybe get involved in some business. And that's, the way we look at the shape of the curve going into concessions. We're always asking the question, how much room has the curve got? Has it used up all the space? If it has, the bond probably won't concede an awful lot of price because it's already conceded enough. The curve's already flattened dramatically, but today the curve hasn't flattened dramatically, so I've been shouting and shouting and shouting. Sell side only bonds. And for that reason, we've obviously had a very, very big sell-off on bonds today. And that's obviously just a very, very simple way of being able to read. If the curve flattens, the concession's over.